Hello traders, in this video we're going to be looking at supply and demand zones formed during the London Open, why they're so profitable, and why so many traders incorporate these zones into their trading plan. If you do like the video guys, please consider subscribing, it is free and you can change your mind at a later point. So let's get straight into the video. I hope you guys enjoy. So guys, let's actually discuss what the London Open is before we dive into some price action. Now, the London Open is the opening time of the European trading session, and this is when the European banks generally start trading. I say generally just because it can pick up slightly before or slightly after. Now, the session itself is the highest volume of any trading session, and it also has the highest average price movement per pip. And that surprisingly also goes for non-European pairs as well, such as the dollar-yen and the Aussie dollar. Occurring straight after the Asian session, which is renowned for ranging price action and liquidity build-up, the European session is known for large price movements sweeping through Asian session liquidity. With all this information known, guys, how can we take advantage of this? What we can do is locate supply and demand zones formed during the London Open. These zones are likely to contain the highest amount of volume within, and therefore are more likely to reject the market. Not only that, but they will provide higher returns simply due to the larger than average price movement and Asia liquidity sweeps that occur during the European session. So guys, we're going to look at an example of the euro dollar. This is a trade I actually took yesterday. This is on the 27th of October. So we're just coming into the London Open. Personally, I would just be waking up around about this time. It can be beneficial if you are living on my side of the world. If you're in a different country, then it will just be happening later on in the day or sometimes in the evening. Depends on where you are. And obviously you can look to trade other sessions if it doesn't suit your trading preferences, guys. But say we're just coming into the London Open now. We want to start looking at some structure just so we can determine the momentum that's present in the market. You can actually see that there is this bullish momentum to the downside. We can see that it is imbalanced by here. We can see that this is significant structure to the downside because we've had breaks to the downside, had minor structure breaks to the upside by here. We keep playing price. We can actually see that the market breaks above this major high by here. So we're going to mark this out as a swing low, guys. We're going to follow the market back. We can see that there was breaks to the upside, breaks to the downside. We can see that this is the last swing high. And we're going to follow the market again. Now we ignore this. I've got it labeled as yellow, guys, just because it's spread hours. We can see that this would have been, or this would have been the last swing low, which was obviously taken out by the market. We know that the general consensus now is bearish. We know that the market is likely to push lower. So we're going to wait. Now you're going to see the volume actually start to increase. We've got average volume here during the Asia session. We're expecting a break of the swing low, guys. You can actually see some imbalance left up here, which the market may look to target, but we know that the Asia session is quite inefficient. We know that the imbalance sometimes won't get mitigated. So we're going to keep playing the price, and we're going to expect break of the swing low, like so. We can follow the market back, looking for imbalance. We're going to look for a supply zone, guys. So we can see imbalance by here, albeit very small. We can also see imbalance here, guys. Obviously, this is going to look different depending on what time frame you're viewing the chart data on. We can see that there is imbalance here. And in our strategy, we do draw our zone from the last counter trend candle before all imbalance. Now, some people will look at this bullish candle by here, guys. Personally, we can see that the wick of this candle is higher than the wick that came before. So this is the counter trend candle for us. What you can do is you can either draw it from the full candles and length, or you could actually look to refine it to the wick itself. And that's simply because there is going to be a bullish candle within this, which is likely where the imbalance source is. I'm going to keep it simple today, guys. And we're going to draw our order right here. You can either have, depending on your risk tolerance, your stop loss at the upper wick, or you could actually put it on the swing itself. This will become a new swing high, guys, once we get a new swing low fall. And we're going to play the market. Yeah, nice tag. You can see that the volume has started increasing now compared to what it was mid-Asia session. We know. And this, guys, isn't the true volume. This is actually based on tick data. Obviously, the Forex market is decentralized. We don't have access to intrabank data. You do have to pay a lot of money for that. But if you did, the volume would look different to this. This is not completely accurate, and there may be a lot more volume than what this data actually suggests. This is why we go by time, guys. This is why we're looking at the London Open. We know that the banks are starting to trade around this time. Obviously, this is quite good in telling us where the volume is, but it's not completely accurate. It can be obviously more accurate for things like stocks and indices. We'll play the market, guys, and you can see that with the strength of the the European session volume, you get a nice large price move, which will obviously allow you to target higher returns on your trades taken during the London session. So we're going to look at another example, guys. And just in this example here, obviously we're going to be looking at this price action by here, but if you actually do come back, you can actually see that when the market spikes during the London Open, the market's actually come back into this supply area, and it's continued its bearish momentum. If we can see here, we do get this strong push down. We get a swing low performance by here. We get a weak break. And personally, within our community, guys, we don't count 2 candles as a break of structure or swing structure. We get another break by here, guys. Very weak break during the Asia session. We know there is very low momentum behind this. There's no imbalance formed. And we follow the market back to the last swing high. Now, all of this is occurring between a major low and a major high, guys. So this isn't the swing. This would be the last swing for us. This would be the significant structure we would require to break if we want to look for a long setup. Now, you can already see, obviously, we're not going to go into liquidity in this video, guys. You can see a massive amount of liquidity that's built late US session and mid Asia session. The market started sweeping through that. So not only have we got weak breaks of the swing structure below, but we've also started sweeping into this buy side liquidity. So we're going to look for a long setup, but only once this swing high has been broken by here. Market swept slightly below. And you'll get a lot of traders going short at this moment, guys, but looking at the liquidity and this ranging price action, you're less likely to get a decent setup short. Obviously, you would have had a chance to actually lock in break even if you did get into a setup here. Obviously, depending on if you had a stop loss above, counting for the liquidity above. But we've had a break of the swing high, guys. So we're going to draw that across, and we can see that there's a nice imbalance push, lots of momentum. Obviously, this is going to have more volume simply because it is a European session. And this is fresh, guys. We've got obviously imbalance here. It's been mitigated numerous times. We've got this imbalance by here, which has been mitigated once. This is where the volume looks to really kick off. Also where the fresh imbalance is. It's very fresh, which means we can look to use the unmitigated imbalance rather than mitigated. And we're going to simply draw our order block from the last bearish candle. Now again, depending on your risk tolerance, guys, you can have your order set at the bottom of the order block. You can see that there is liquidity beneath. You'll also have a small amount of liquidity by here. So you can actually look to account for this with your stops. Now, I'm not going to go into profit taking in this video, guys. I will make a future video on profit taking. But like I said, this is happening during the European session. So if you do get a nice setup formed, which is tagged in and rejects, you're going to be able to target those higher returning margins. But to tag into our trades, like I said, guys, depending on your risk tolerance, you can literally put your stop loss at the bottom of the candle. You are going to get higher returning trades, but you do increase the likelihood of you getting tagged out as well. So it is down to your own discretion and back testing. So I will show you a couple of quick examples on other pairs there, just so you know it does happen on other pairs. But the euro dollar obviously is a European pair and it's the most traded pair in the world. So you are going to find that this strategy is going to work the most effectively on the euro dollar. But say we're coming into this price action by here, guys, we can see that the market is ranging a great deal. You've got this swing high, this swing low by here. And if we come across, we can see that it's actually within a larger range as well. So we'll draw this across. We can see that this is clearly a swing low with breaks to the downside, followed by breaks to the upside. And as we come up, we can see that there's no major structure being broken until by here. This is the swing point. We pull that across. We can see that it didn't break out by here. It did break down. So this is our swing high, guys. This is our swing low. And obviously this would have been the last swing high. So the momentum is bullish. We're trapped in this giant range. When we come down, we can see that we've had a nice push by here, guys. The market's come back down into this demand zone before ranging again. So we're going to wait for a long setup. Obviously, like I said, the momentum is bullish. We do actually have quite a lot of liquidity built up by here, which the market looks like it's already sweeping just before the London Open. Now that we've had a sweep into this liquidity, guys, if we get a break by here, this is significant structure. We can look for an entry on a fresh demand zone form. So we get a breakout. We've got a nice push above, nice imbalanced candle. And what we're going to do, guys, is we're going to follow the market back to the extreme. Now, most traders, especially SMC traders, ICT, supply and demand traders, they go from the last counter trend candle before the last break of structure. Not us. We go all the way back to the extreme. We can see that there is imbalance by here. We can see that this is the last bearish candle. Obviously, you could, if you wanted to, depending on your risk tolerance, use this bearish candle by here. We're going to use this candle, guys, just because the imbalance really starts up by here and it's quite clear to see. And again, you can put your stop loss on this bar, on the bottom bar, sorry. And as the momentum is bullish, we can actually target the swing high in this case. Or you can trail behind structure. Now in this example, guys, you may have been taken out. Looks like we literally were a few ticks from being taken out there. And like I said, down to your risk tolerance, you can have your stop loss on the swing, or you can have it slightly below, just to account for any pullbacks deeper into this demand zone. Here are some other zones, guys. These are on the dollar yen. As you know, the dollar yen has been a bit messed up over the last couple of weeks. If you are watching this in the present time, but you can see that this actually still plays out on non-European pairs as well. You can see we've got a London Open supply zone by here. It's tagged, and that would have had nice price movement. Same by here, although you wouldn't have had as much price action there. And you get a lovely demand zone formed by here. Each time you can see it's correlating by higher volume on the market, and you get very decent price movements there. You were to get in on these zones, guys. The Vaga Academy is up and running, guys, and you can get access now through the link in the description. It includes all the knowledge I've picked up on over my 7 years of trading, and you can be one of the first to learn my simplistic single time frame approach to trading the markets. The course covers 4 hours of content, including my blueprint on market structure and the free setups that I trade personally, and you also get access to the premium community, which includes daily support and price discussion from members trading the same plan, and also weekly forecasts and breakdown videos from myself. And I hope you have a lovely trading week. I will catch you in the next one. Peace out.